Hi everyone, I'm Thomas from AIA Investment Management. In this next issue of our video, in the next couple of minutes, I'll be covering some key global market highlights as well as important investment messages. First, let's take a look at market performances. Cooling trade tensions between US and China saw global equities extending its recovery, with the US equities returning back to positive territory for the year. After hitting a low on the 8th of April, global equities saw strong relief rebound between the range of 11 to 13% over the past 4 weeks. Turning to economic data, US economic data remained mixed. While we saw better than expected employment data and inflation figures, retail sales for April slowed down as consumers scaled back spending over tariff concerns. Given uncertainties surrounding Trump tariff, global central banks like the Federal Reserve continue to hold its key interest rate unchanged in the range of 4.25 to 4.5%. Next, let's take a review on some recent Trump tariff updates. US-China has reached an agreement to a 90 days tariff pause after a meeting in Switzerland. In essence, US tariff on China imports down to 30% and China tariff on US imports down to 10%. This is from the initial 145 and 125% respectively. Trump also announced and mentioned that he may impose tariff back to the initial level if trading partners do not negotiate in good faith. As such, a lot of unknowns remain over where tariff rates will ultimately land. Most recently, we have also seen Moody's rating downgrading US credit rating by a notch to AA1, joining Fitch and S&P in grading US one notch below the highest AAA rating, citing concerns over US ballooning debt and deficits. So, in current uncertain and volatile market condition, how should an investor navigate his investment portfolio? Importantly, the key message here is it pays to stay invested over the long term across multiple market cycles and do not attempt to time the market. Why is that so? Looking at the chart on your screen, looking at S&P 500 performance since 1949 over various multiple bull and bear market. The average bull market has appreciated around 265% for an average of 67 months. Now that is 5 to 6 years. On the contrary, the average bear market over the same period dipped by an average of 33% over an average period of 12 months, and that's only 1 year. In summary, bear markets have been shorter and less impactful as compared to bull markets. So at the end of the day, if an investor stays invested over time, they can enjoy positive returns at the end of the day. How can AIA then help our customers? Active portfolio management is critical to help our customers navigate the uncertainty, helping our customers to stay invested over the long term rather than trying to time the market in order to gain full market cycle returns. Through AIA Stewardship, we partner leading investment managers to deliver long-term wealth creation and help reduce some common customers' pain point as listed on the top half of your screen. So with that, I'm signing off and looking forward to the next issue.